What's going on, guys? Welcome back to the channel. And in today's video, we are going to be talking about what I deem an A+ setup using the concepts and logic with ICT and volume profile. That's the way that I trade. I marry those two concepts together to come up with my trading strategy. Now, everyone's strategy has lower probability setups and higher probability setups, right? This, if I had to pick one, this would be my definition of an A+ setup. All right. Some people like to use the term forever model. If I had a forever model, it would definitely be the setup that we are going to go over today. So stay tuned for that. And real quick, I just want to give you guys an update on the course that I'm working on for ASFX TV. We got a couple of the first videos done. So I really feel like I'm starting to get into a flow, and I'm really hoping we could have this finished in maybe 2 months. 2 months max, I think I could get this done. The hardest part for me was trying to figure out how I can structure it for somebody that knows nothing about ICT and nothing about volume profile. You know, I assume that most of you guys who are going to be watching it already do know quite a bit about both of those concepts if you're watching me trade live on ASFX TV. But, you know, just in case, to make the course coherent, I have to do it like that. So I think that was the hardest part about getting started, because I've never built a course or taught my concepts in that way, right? But I think we got that part nailed down. So hopefully the rest of the videos that I make are going to be a lot smoother of a process. So I'm excited about that, but enough yapping about the course. I want to get into the charts and just get right into this. So this is what I would call my forever model, or my A+ setup. Now, I'm going to go over every element that makes this an A+ setup one by one. So if you see this schematic, you don't have to worry too much about what's going on this leg up, but what we are going to focus on first, step one, we need to see price trade into a high time frame level. So what constitutes a high time frame level for my intraday trading would be anything above the 1 hour. And we're specifically going to be looking at either 1 hour to 4 hour to daily fair value gaps, order blocks, or just clear swing points. So that would be a swing high or a swing low on nothing less than a 1 hour time frame. Now, why is that? Pretty much you're going to get the best reactions out of levels, especially intraday, if you're trading out of a higher time frame zone. There's just a bigger accumulation of orders, resistance, support, whatever you want to call it. You're going to get better reactions intraday based off those higher time frame levels. So this is one of the most important elements of the setup, because we need to frame our intraday movements. You know, we're looking for volatility intraday. To get that volatility, it needs to happen out of a higher time frame zone. So for the sake of the A+ setup, we're going to be looking at high time frame zones, nothing below a 1 hour. Now, a lot of people like to structure the way they're going to enter the market based off what time frame their higher time frame zone is coming from. So for example, if you're using a 1 hour zone, you might want to be looking at 5-minute structure and 1-minute entries. If you're using a 4 hour zone, you might want to be looking at 15-minute structure and 5-minute entries. And daily, you'd be looking at 1 hour structure and 15-minute entries. Now, that's not a clear cut, like you have to follow that rule. But if you're just coherently kind of narrowing down the time zones, it makes sense to go with that. You don't want to look at a 4 hour zone and then expect to find like a prime entry on the 1 minute, right? So that's a quick thing that I would definitely implore you to study. Now, again, that's not like a hard set rule in this model, but it will help you get the right entry. So we're going to be looking at a 5-minute entry, and we're going to be looking at a 1 hour zone. So that's the first thing. You need to get that reaction out of a higher time frame zone. Number two, we need to see SMT divergence at the zone. So in this example, we'll be looking at SMT divergence on the ES and the NQ. That's what I primarily trade. Now, quick overview of what SMT divergence is. SMT divergence is a price action divergence between two correlated assets. So for this example, we're going to be using the ES and the NQ. And pretty much in the most simplest way I could go over SMT divergence, if you see right here, let's pretend this is the NQ, and NQ tapped into this 4-hour or 1-hour fair value gap. We're expecting to see some volatility come in and get an intraday reversal down to a certain swing point, and we'll go over that in just a moment. NQ makes a higher high when it goes into its high time frame zone, right? Now, what we would need to see ES do to classify an SMT divergence would be this. If NQ made a higher high, then if ES is going up like this into the zone, ES would need to make a lower high. So this would be the divergence between two correlated assets right here. NQ makes a higher high, ES makes a lower high. Now, you don't want to just use that alone, right? So this is what I'm talking about, how we stack confluences in our favor to create a high probability setup. If we get into that high time frame zone, ES and NQ are tapping into high time frame resistance in this scenario, and then we get this bearish SMT divergence between the two correlated assets. Now we have two really strong confluences to start building out our high probability short idea in this case. Now, step number 3, we need to get an entry point, but we also need a draw on liquidity. So believe it or not, your entry is actually the last step in formulating a high probability trade idea. Before you can worry about your entry, and I talk about this all the time, right? Narrative. Before you could actually just go entering into the trade, you need to have a directional bias in the form of a draw on liquidity. In my opinion, this is one of the strongest parts of ICT concepts, is it doesn't just give you, blind entry signals like, oh, if it does this, buy, if it does this, sell. Instead, it gives you a reason for why the market may go to where it's going to go to. So the narrative in this case, using ICT, we would be looking for a draw on liquidity. Now, there are a few different types of draws on liquidity. Some of my favorite ones, and what we're going to go over in my example in just a minute, is going to be equal lows. So it could be equal lows or equal highs. Now, again, what is the significance of that? A lot of people actually like trying to, let's look at the case of two equal lows, so a double bottom. A lot of people like trying to long here at a double bottom, right? They go, oh, double bottom, clear support, because it bounced there 2 times in a row, and it's holding really strong, right? I guess that makes a lot of sense on the surface, but what we believe, trading ICT, and I really implore you, if you're new to ICT, to start studying this, equal lows almost never actually hold. All right. What happens more often than not is these become clear swing points for people to place their stop loss orders. Now, what happens? What is the whole narrative behind what the market is doing? The market is hunting liquidity, engineering liquidity, rebalancing inefficiencies. Those are the 3 things the market is doing at all times. So right here, it was engineering liquidity in the form of equal lows. The market wants to hunt liquidity. And what happens is we use these equal lows as a draw to trade down towards. So that's the idea behind it. And in the example I'm going over, we're going to be looking at equal lows. Now, again, equal highs, equal lows, same thing. Stacked highs, stacked lows, same idea. It's just a really obvious placement of stop loss orders, and we look to target those as a draw. Now, and this will be more clear when we get into the actual price action. Now, the one other form of liquidity you can use is session liquidity or time-based liquidity. So that would be in the form of previous day's high, previous day's low, previous week's high, previous week's low, previous month's high, previous month's low, or session liquidity like Asia session lower high and London session lower high. Those are at least the main liquidity pools that I use to target in my trading. Now, again, these are just like levels. So you could actually look for reversals at these levels in certain cases, and you could use them as directional targets, where the market is going to pull towards to take out those obvious stop orders. So that's step 3. So let's just go over what we have so far. Number 1, high time frame zone. in the form of a fair value gap, order block, or swing point, nothing below the 1 hour time frame. Number 2, SMT divergence. Of course, we're using examples on the ES and the NQ. So we would need SMT divergence at or around the higher time frame zone. That's confluence number 2. Confluence number 3, we need to draw on liquidity in the form of equal lows, equal highs, session liquidity, Asia low, Asia high, previous day's low, previous day's high, etc. What is the last step? Step number 4 is going to be our entry. Now, again, I talk about this all the time. Your entry is important, right? It's a very important piece of the puzzle to getting a high probability setup. But I think a lot of newer traders get obsessed with trying to get like the perfect entry point. And while it's important, if you don't have all of these other components, you're not going to get a high probability setup. All right. There are entries all over the place. Constantly, you're seeing, you're giving yourself reasons to enter the market, but you need these other components to actually formulate a directional bias, a draw on liquidity, and give yourself narrative for why the market may want to go in the direction it's going to go towards. But with that being said, your entry is important. So what we're going to be using for my model, my high probability setups, is the inversion fair value gap entry. So this is how it goes. When the market is in this uptrend, oh, you know what? Before we get into that setup, to the inversion fair value gap part, I do want to go over this real quick. When looking at the high time frame zone, because this looks like a reversal setup, right? Doesn't always technically have to be a reversal. If you see right here, I say extra points if we are in line with the trend. So I know from this standpoint, this looks like a reversal. But if we're using higher time frame context and narrative, and we're trading off the 5-minute time frame, which is where I get most of my entries, this really just has to be a pullback inside of a 1 hour trend. So when we're zoomed out on the 1 hour, all of this just looks like maybe a shallow pullback to a relevant zone. But when you're down there on the 5 and the 1 minute, it looks like this, and it looks a lot more like a reversal. So it's not always like a higher time frame reversal. A lot of times, the best setups with this model actually come out of following the higher time frame trend. So sorry about that tangent, but I did forget to mention that when I was going over step 1. So back to the last step, step 4, our entry. We're using the inversion fair value gap model. So again, this will be clear when I get into the price action in just a moment, but let's say when the NQ, let's say this is the NQ, tapped into its high time frame level, it also created a fair value gap right here. Now, if the trend is going to continue going up, fair value gaps are supposed to be the points where the market is going to retrace to and then go higher. So we already have step 1, 2, and 3, right? So we're already formulating a lower time frame reversal from this zone for a few other reasons. This is the last piece of the puzzle, because if the market is going to continue going up and it's not ready to reverse or retrace, then this fair value gap, in theory, of course, nothing is perfect. Nothing's going to work 100% of the time. But in theory, this market should retrace to that fair value gap and move higher. So what the inversion fair value gap does, and why it's so powerful for getting a good entry, is it's giving you that last piece of confirmation. So the fact that we close beneath what is supposed to be a bullish level that should continue price higher, that's the confirmation in the last piece of the puzzle that your trade setup is now underway. So when we get that inversion, there are 2 ways to enter this. If you're really aggressive and you feel really good about the setup, you can enter on the close of that candle after it inverses and put your stop at the high. I do that very often, and then you would look for the equal lows or whatever liquidity you're targeting here. But another way I like to do it is actually wait for a retrace. So I could put like a limit order inside that inversion and look for like a break and retest of the inversion fair value gap to then go lower. Or you could do something like pull a fib from the swing high to the swing low that broke structure, because this is also your market structure shift, right, guys? I'm sure you remember that from the last video. Right here would be a valid market structure shift. Why is that? It is the last higher low that made a higher high, and then it was taken out. So there's your market structure shift as well, and your inversion fair value gap. So what you can do is, if you don't want to, let's say sometimes like the candle that inverts that fair value gap can be really overextended. Like it might be all the way down here. Maybe you don't want to enter that low, right? Because you're almost guaranteed. Here, let me move this over. You're almost guaranteed to get a pullback, right? And if you do this and you want your stop up at the high, now you're not really getting great risk reward. I mean, you can capture 1R right here, but like 9 out of 10 times, the market is going to have that retracement. So you might as well try and be patient and get yourself a better entry somewhere in here on a pullback. Now, you're going to miss trades every now and then, but I just prefer to do it like this. I like to get into my trades on limit orders and wait for that tap of the level, like a retrace. Or you could have a more simple rule where, like I was just about to go over, you pull a fib from the swing point and then look for that 50% retracement. And you could have a limit order there. Just gives yourself a little bit better of an entry. You're sitting in drawdown for less. You get a better R multiple down to your target. And you don't even have to have a limit order here. If you want to be extra cautious, you could wait for that retracement and then get in like on the 1 minute as it pulls back down, something like this. There's a million different ways to skin the cat, but again, the core concepts here are what's actually formulating the narrative and why we're taking this trade. But this is going to be the trade, okay? So once again, I don't want to make it too long because we got to get into the price action. High time frame zone, hourly or above, hourly fair value gap, order block, or swing point. Step number 2, SMT divergence. So again, price action divergence between two correlated assets, ES and the NQ. Step 3, draw on liquidity, equal lows, equal highs, or any kind of session liquidity like Asia high or Asia low. Last step, step 4, your entry, inversion fair value gap, market structure shift, either get in on that close or on the retrace, and then put your stops above the high and target the draw on liquidity. This is the forever model. This is the high probability setup. Now, let's go into the ES and actually go over a specific example. I'm also going to tie in the previous day's point of control to this. Because again, I mean, that's another major component of how I trade, and we haven't even talked about it yet. So I am going to explain how we could add the previous day's point of control into this model. But let's go into the replay mode. We're going to be looking at this price action. So this was only from last week, and I did take a trade like this, and I took it on ASFX TV using the exact concepts we're going to go over. So again, you can always check out that stream. We do have replays on ASFX TV where you can go back and watch me take it live. But let's go here. Let's, of course, as always, put on our volume profile levels. So as you can see, I have the previous day's point of control on here as well, right there. This is the previous day, right? We're using the previous day's profile. Let's also look at previous day's high. That was relevant at the time. So we'll mark that off. Previous day's low, we don't really need to look at. I mean, it's right there. But I just want to go over what the most relevant levels are, which is the point of control and previous day's high. So we got that on there. Let's actually go a little bit. We can keep it like this. So number 1, we're looking for a high time frame zone, right? This is the leg that we're going to be taking our trade from right here or right here. And I'll go over, there are 2 trades in these 2 price legs that you can take using these concepts. So first off, we need that high time frame zone though, right? So let's go to the 1 hour. Right here, what is this? A clear swing point. So let's mark that off. This is a clear 1 hour swing high. What did I say? Higher time frame fair value gaps, order blocks, or swing points. This is a clear swing high, a place where there is an obvious large amount of stop loss orders. Now, we could even go to the higher time frame, and I could show you one other level that coincided with this, which is this 4-hour order block. Now, it's a bit far away. You don't have to do that. You could stick to the most recent price action. This is enough. But just to show that there is confluence on the even higher time frame, we have a 4-hour order block right here. Now, what is an order block? I'll make a whole video on these eventually. But essentially, A bearish order block in this case is the last up candle or series of up candles that breaks structure. So if we see right here, we broke structure right here, right? We made a new low. The last series of up close candles or singular up close candle is your order block. So I would mark off this whole section right here. Now, let's drag this out to the current price action. And look at that. Perfect reaction inside the order block. So again, you don't even need that. You can look at the most recent action right here. This is a 1 hour swing point, strong enough level to look for this model. But just adding confluence. Again, I love stacking confluences. It gives you higher probability setups. You are also tapping inside a 4 hour bearish order block. Okay, anyway, let's go back down to the 5 minute now. So we have our clear swing high, right? This is our level that we are basing the whole idea off of. We swept this high. What did we do next? We look for our bearish SMT divergence. So if we go here to here, I'm going to show you guys NQ in just a moment. Note that ES made a lower high right here, right? Inside the high time frame zone, the 1 hour swing high. Let's go to the NQ real quick and let's just timestamp this. This is 8:45 a.m. to 11:55 a.m. on June 5th. Let's go to the NQ. 8:45 a.m. to 11:45 a.m. NQ put in a higher high. So NQ put in a higher high. ES put in a lower high at our clear higher time frame zone. So that's step 2. High time frame zone, 1 hour liquidity swept. Step 2, bearish SMT divergence has set in. At that point, I'm bearish. I want to look for shorts, right? I mean, that's the key. Like those are the 2 most important parts of this to at least get the directional bias. I want to look for shorts. So what I'm doing next is looking for a clear target. Now, what did I talk about? Equal highs, equal lows, or session highs and session lows? Well, look what we have right here, nestled on the ES. Let's put this back here. We have equal lows, relatively equal lows right here, untapped. So this becomes our draw on liquidity. We have our higher time frame zone. We have the bearish SMT divergence, and now we have step 3 met. We have relative equal lows that we are looking to target. And as you can see, the market did end up sweeping this level. What is the last piece of information we need? We need the inversion fair value gap. Now, we're using the 5 minute time frame to base our entries, right? Let's get rid of previous day's high just to not make this chart so messy. Obviously, it's right here. That's another level of liquidity that we swept. We swept the previous day's high. But of course, we're focusing on the 1 hour swing high that we swept because that's a higher time frame level. Where's the nearest 5 minute fair value gap? Right here. In theory, if the market is going to continue the uptrends that it's in, this fair value gap should hold and we should continue higher. We get a tap in. It tries to go higher one more time. We set in that bearish SMT divergence. And then what do? We fall down and we inverse the fair value gap right here. That's everything we need. So what is the aggressive way to take this trade? This is technically not a closure beneath the fair value gap. So if you're trying to be like A+ in textbook, you can't go short right here because we technically did not close below the gap. We tried to. You can see this wick, but we could not get the closure. So you actually, if you're trying to be textbook, you cannot take this entry. Now, you can take this one though, right here. This is the closure. This is a legitimate inversion. So let's put that here. This has turned into an inversion fair value gap. Now, this is the first entry you can take. And you would be targeting those equal lows. Now, your stop could either go above the most recent structure right here, which could net you 1.7 R, or you could be more aggressive with your stop loss. I like to be more aggressive. Again, that is preference. I'm really just trying to hone in and focus on helping you build out your trade thesis. Okay. There are a million different ways to place your stop loss. You could be aggressive and place your stop loss one tick above the inversion fair value gap, because in theory, the market should not go back above that level if we are right on the trade. Now, again, sometimes it does and you're still right. Sometimes you're wrong and it does go above. Trading is not perfect, but in theory, and with a high probability setup, you should be able to keep your stop loss placement right above the inversion and it should be protected. Now you've been able to give yourself a little over 2R, almost 3R actually, 2.7R. Now this is entry number one. What is one thing, if you guys are following me and you know how I like to use volume profile, what is one thing that is wrong with this setup? I'll let you think about it for 2 seconds. Previous day's point of control. At this point, we are still above the previous day's point of control, right? What is the golden rule? If we're above the previous day's point of control, we look for longs. If we are below the previous day's point of control, we look for shorts, right? That's the golden rule. Now, technically, we do get like a minor break of the POC right here. So, I mean, technically, you're now below the previous day's point of control, and you are following the golden rule, but it could be a little sketchy. Like if you're not used to this model, but you are trading with the POC and you're following that rule, you might be a little sketched out taking this one. So I'm going to show you guys one other entry you could have where you really follow the previous day's POC. Okay, so again, just overview, higher time frame tap into a strong resistance level, the 1 hour swing high, we sweep liquidity. Step 2, bearish SMT divergence between ES and NQ. ES makes a lower high, NQ makes a higher high inside the higher time frame zone. Step 3, relative equal lows as our draw on liquidity. Step 4, inversion fair value gap entry point right here. So let's say, okay, I know I want to get shorts, but I don't want to get short right here. Now, should I get short here? Maybe. This still could have worked and given you a good risk reward. But if you want to be more patient, one more really, really good entry. And I actually took this trade. So I took this entry later in the day. So that's why I want to go over it. You could wait for the pullback. Now, waiting for the pullback, sometimes you're going to miss the trade. It's just the way it goes. But sometimes it's better than trying to follow this momentum. How many times have you been like, oh, I'm going to miss the trade, and then you get in right here, right? Because you're seeing this big black candle going right to your target, and you get in right here. And now you have to either have your stop all the way up here or above here. And, now you have to sit through like an hour of chop. And you don't even get a good risk reward here. I mean, this is a terrible trade if you do something like this. But how many times do you do that following momentum? Waiting for the pullback is so helpful. Now, where would we look for a pullback? Fair value gap. We'd look for a pullback into a bearish fair value gap. As long as the bearish fair value gap holds, we want to get short and target the relative equal lows. This is the pullback that I took a short from. Now, really important thing though. Let's say that instead of, if you see right here, this leg down, we did not take out the equal lows. And then we pull back here. That makes the setup viable still. If we took those equal lows and then started pulling back, this setup went from being an A+ setup to a C-. Okay, why is that? Because the objective has been taken. So in this case, if we were trying to wait for that pullback, but this market just continued to slam down to take those equal lows, and then it starts pulling back, I would be a lot more cautious of getting involved because this was my target. Target's been met. Now we do sweep that level and then we pull back and we go lower. But this is going to be context dependent. On this day, there were like higher time frame draws on liquidity as well that you could be targeting. So it worked out in this case. But general rule of thumb, if this is what you're targeting, if your objective gets met and you missed the trade, then you missed the trade and you just got to deal with it. But in this case, and this is actually one of my favorite ways to look for pullbacks, when we get really close to sweeping my objective and then we get a deep pullback. So again, where can we look for that pullback? Into a fair value gap right here. Look at this fair value gap. Boom. So 2 ways of trading this. Number 1, let's actually pull a 50% fib as well. What do we talk about? Premium and discount. This could help you get into that really prime entry. Do not get short until we retrace 50%. So instead of being like, oh, I need to get in, then you get in here. Or even let's say you're trying to get in here. You're like, I'm going to get in right here. Look how much chop you have to deal with in drawdown. If you just wait for a retracement to the 50% to equilibrium and you get back into a premium of this price leg, you'll get a much better entry. And that's exactly what I did. So I waited for a retracement to premium, and then I got in here, and I literally just got in on one of these candles. I don't remember exactly which one. And I put my stop right above the POC, and then I targeted the equal lows. I was able to capture 3R. So this was my setup. So I didn't even take like the prime setup up at the highs, but I wanted to go over this example because this is just as good of a setup as this one. Now I could have captured more points from the top, but if we're following the golden rule and we don't want to get short like right at the point of control, that's totally valid. So that's why I wanted to go over this example as well, because now we got that strong break between the point of control, or below the point of control, excuse me. And then we wait and we're patient for the retracements to equilibrium and or a clear bearish fair value gap, because that becomes our line in the sand. If we got a 5-minute closure back above this fair value gap, my trade thesis is just like, at that point, it's either invalidated or the price action is just not really ideal for what I'm trying to do. Either way, I probably don't want to be in the trade any longer regardless. So, that's how you use those lines in the sand. But this is my A+ setup. Now, I'm sorry if this was a long video. How long are we going? This is 31 minutes long. So it's going to be a bit of a longer video, but I think there has been a lot of value dropped here. I mean, this is the A+ model. If you can use this model and really hone in on these concepts, this setup will make you so much money, I promise you. But you need to follow it, okay? And you can't cut corners. Now, last thing I'm going to say, I will be talking about these setups and concepts in a much more coherent manner when I build out this course on ASFX TV. So always check that out. But regardless, I will be right here and putting out weekly content like this to talk about my concepts for free regardless. So tune in for next week, guys. That's it for this video. I hope you enjoyed it. And please, while I'm trying to continue to grow this channel, a like, a comment, subscribing means the world to me. So I could feel motivated to keep putting out this content for free. Thank you so much for watching, guys, and take care. I will see you next week. Peace.